Good morning, everyone. Today is July 29th. Welcome to the Options Trading Live. My name is Josip Kosik. My email address is down here. Feel free to contact me. If you email me, I usually respond quite fast. We're not a financial advisor. If you can take a moment and read the disclaimer right here, even if you need to stop it. The place where you can get in touch with me is right below, and also I have this web page where I usually post the trades that we do. So last session what I did was on July 19th, and we are going to go over that trade a little bit later on. So good morning, Joe. Good to see you. Thank you for confirming that the sound is good. And I'm going to just click here to show you what the market is doing this morning. So it rallied up off the open, and now it's a little bit pausing. So that's very good um, for our open positions. And we're going to be looking at the current situation with the SPY. So SPY has an auto climate that has confirmed a clear uptrend, and we are currently 2 days above the 9-day exponential moving average, when on average you can be about 3. And what is interesting to see here on a chart, we are approaching a major level of the resistance. Also, at the same time, it's important to know that the VIX is low, so we have a calls and the puts that are decreasing in value. So if anything in terms of the options, what we can do, that would be buying the options. So buying the options would be the right thing to do for this particular session. So, do we want to buy something when we are at the all-time high? Well, that's the tricky thing. So, what I'm planning to do is to look at the SPX and to consider the trade that is going to be buying, but it's also going to be financed by one of the credit spreads. So, one more time, I want to tell to you that the market is up under the degree that it doesn't look to me that is sustainable, because we had too many of these back-to-back days. Let me just show it on the monthly, leaving the gaps behind, gap behind, gap behind. And normally those gaps do get filled. The question is only when, right? So back to back, a number of these days under the angle that is unsustainable, coming into this area of congestion is really something that I want you to be aware of it. So having a look at the SPY, which is 1/10 of the value of the S&P 500, I want to consider placing on the SPX 500, which is a settle in cash. And again, very similar situation with the difference that this is a 10 times greater product. And when I type in here 55 minutes and scroll down here within my vision, I actually see that we do have a resistance in the area of the 4130 to the 4164. So what I'm planning to do this morning is very simple. I'm going to be building a trade which is going to involve a couple of pieces. One piece is going to be the bull call that is going to be financed by the bear call, and that is known as a broken wing butterfly. So I'm going to bring this here and just kind of type in BWB, stands for a broken wing butterfly, and it's going to be built with the calls. So this would be the call broken wing butterfly on the SPX, and I'm going to be targeting. So the gut is going to be the exact area of that supply zone. So that supply zone is between the 4130 and 4164. So if I know that, then gut should be right somewhere in between that area. So having said that, one of the things that we can figure this out is simply to pull up the option chain. Good morning, Jeff. Good to see you. Um, and on the option chain, we are going to be focusing on an option that is expiring today. Tomorrow, I also have a session, so we can then go over that trade tomorrow and know exactly what the outcome is going to be. And because we are looking at the out of the money, we need to actually add a lot more strike prices. I'm adding like up to 20 strike prices, and I'm going to be now just moving this in my target area. So one more time to make the things a little bit more clear, I'm going to use this tool to circle what the current price of the S&P is. It's 4,100, and we are looking here the price at 4,150. So we would need to scroll down to get more of the strike prices that are anything above the 4150. So obviously this area right here that I'm putting the um, horizontal line on is current at the money. The strike prices are right here, and we are now looking anything. Well, I say north, but in this case is a south in the terms of where we are looking at. And one area that I always pay attention to, and let me just change the color in blue, is both open interest and volume. So we have here volume, and when I look at here visually, there's a one 5-digit volume that it's really poking my eye, and this is that area of the 4150. So one more time, the idea behind me placing this trade would be that I would buy out of the money bull call spread and then finance it with out of the money bear call spread that is wider. So that's the mouthful, but that's a lesson for today. And what I'm going to do right now, I'm going to now actually build this. So, and then the step two is going to be go over the review the existing trades that we already have. Review the open positions uh, in the paper trading account. Okay, so that's less important. Okay, so let's now start building this. So SPX is currently trading and it's already going down 4,100, and we are going to fire this trade in and then walk through it slowly. Okay, so 4,100 is right here, so I'm looking right here, buying this area right here. So this volume that was 26,000 is already now to 31,000. So if I now go ahead and buy this call that is only 40 cents, okay, so that's gonna be filled any second. It's not getting me filled. It's not getting filled because this thing is going down. So let's make it 45 cents. Okay, so now I'm filled at 41 cents. I want to finance that, but this one needs to be greater than 45 cents. So what I'm doing right now, I'm selling the 50. I'm selling the 50, and we said the 64 is a high, so let's pick the 65 because obviously we don't have a strike prices. So I'm taking the 55 cents as a credit. So now when I send this in, so that 65 has actually financed my buying of the 45. Okay, so this execution has taken place in a matter of seconds here, because really I have placed that within the 2 minutes, right? Within the 2 minutes of each other. So I fired the trade in at the 808 and the next one at the 809. But the explanation of this is going to take a little bit more time. So let's now walk through this slowly, not to confuse anybody, and kind of type the piece by piece what we did here and explain it as as a, as a bear call spread that is actually financing the bull call. So this is the current price of the SPX. This is the current price of the SPX. Approximately, it was dancing around 41.02, 41.03, right? So when I look at the one that we did, which was 41.50, and we went long on that. Um, Actually, we went long 41.45, and then we sold to open 41.50. Both of these trades are completely out of the money. And because they're out of the money, somebody would even wonder, what's the logic? Why would you even do that? Well, the whole reason why I'm doing it, so in case the market turns around and start ripping, because this pullback that it's taking place, it's a quite shallow. So I mean, the real pullback would go all the way down and fill this gap and touch the open at the 40.70. That's a possibility. That's a possibility. But now that we have pulled back maybe only, I don't know, 20% of this move, I would not be surprised if there's another leg up higher going into the weekend. That's a possibility. So, one more time, this broken wing butterfly is composed of the two components, right? It's composed of the bull call, which, as you know, it's a debit trade. And in my particular case, this debit, I have paid for it 45 cents. So the trade that I just placed, it involved 45 cents of the debit. And what I'm going to do here, I'm going to just make it a little bit more visual so you will see it, that this is what I paid for this 41.40 out of the money call and 41.50 out of the money call. Now, why would anybody do such a thing? Because I want to finance that with a bear call spread that it's a credit trade. Now, this bull call is 5 point wide. And be aware of it that this 5 point wide spread means that we are targeting on the chart. On the chart, we are targeting actually right here, this area of the resistance. So what I'm visually anticipating to happen is following, and we color this so it appears as a green bar. I'm expecting the bar to go into this area, into this area. That's how I'm expecting the bar to go in. So if I want a bar to go into that area and then close, I will then have my 41.45 becoming in the money. So right now it's out of the money, but if you reach the 41.50, then that's going to be in the money. And how much did I pay for it? 45 cents. And if you reach the target of the 41.50, that would be the nice rate of return in that particular case. So let me now do this with the option chain. So on the option chain, one more time, I'm going to put the expiration on today's expiry, and then we can discuss this tomorrow when I have the sharpening session. How well did this trade work out? We're going to make sure that we don't pick out the money, that we actually pick exactly strike prices that I'm trading, which is a 41.45 as well as a 41.50. So these are the two strike prices that we have selected it. These are the two strike prices that we have selected. So one more time, I'm going to edit the spread to give me exactly the strike prices that we're dealing with, and you will see the rate of return that it's coming to me. It's a wise investment if the price goes to the 41.50. But if the price doesn't go to 41.50, well, that's the other part of the lesson that I'm going to explain to you. But as of now, if I now type in exactly what I got filled on it, so for the 41.45, I ended up paying $1.35, so I got filled on $1.35. And the higher strike price was costing me less, and it was financing some of my outlay of the $1.45, so it was a 90. So when I go over here and I go risk graph, it's this section that I want you to take a look at, because this is the section that is really crucial for for me to elaborate and to explain why this trade is exciting in my opinion, because we are outlaying only $45 to possibly make what, 545. Well, how is that possible? Well, I'll come back to that in a moment, okay? But be aware of it, that if this price that is currently out of the money reaches the 4150, then that thing is going to be worth $5. So one more time, this is the bull call side, and I'm going to maybe create even the we'll call, let's say, entry, right? And when we have here current price of the 41 100, we know that this is all out of the money. Both of these are out of the money. These are out of the money calls, and they don't look that good. But if we reach on same bull call expiry and SPX is sitting, and let's imagine exactly it's 4150, which is really not unrealistic, because while I'm teaching this, what is happening with the bears? Are they winning or are they losing? Is this all that the bears can muster in terms of the pullback from 4120 to 4102? That's only $18 pullback. And if you reach to 4120, 4150 is only 30 points higher. So the other day when we had the Fed day on the bad news, such as increasing the interest rate, we ripped almost 100 points. It's not unrealistic to anticipate that the market can move to 4150 by the end of the session. It's not unrealistic. But just in case I'm wrong, that's why I have the other one. So let's imagine we're right now at 4150. And now we're evaluating my 4150. If you're at 4150, has no value. Now be aware of it. If this was 41 and a 1 penny, then this would have that 1 penny value. But if it's exactly 4150, then it has no value. Now, what happened to this other unit that I bought at 4145? This one, 4145, initially was completely what I like to call out of the money. And in this case, if you look at, it's going to have, in that case, $5 so in the moneyness. So it's going to be $5 in the money. Now, of course, you did not make the whole $5 because you have to pony up the 45 cents as a debit. However, let's now talk about, and I'm going to color this in red, the bear call. And the reason why I want to talk now about the bear call spread, because what if I'm dead wrong, market is tired after running so much to the upside, the disposition that we have created, that we love the fact that we're only listing 45 cents to make this difference. How would then the situation be? Well, then the situation would be a little bit different. So let me just recap this, so later on when I do the that sheet in which you have access to, all the information would be present. So I'm cutting these so I can later on put into this sheet, so you will actually have that information for future reference to go over it and to understand it. So I want to make sure that it has exact information, what that bull call spread was, what we bought, what we sold. So again, I'm getting that information out of the current price here. So having said that, maybe I should also get this risk graph, because it's really good looking risk graph. It shows that we are we're risking less to make more, and that's the ideal situation in trading universe. Now, the bear call spread is different. And why do I say that bear call spread is different? Because this bear call spread is currently not $5 wide, but it's actually, when I show it to you, surprisingly $15 wide. And that might scare a lot of people because that $15 wide spread, let me recap this one more time. I was trying to cut and paste this, but just it wouldn't go through. So one more time, I'm gonna just take it here, and I apologize for confusion here. So this is a bear call spread. 41.65, 41.50, that's a $15. That's a 1,500. But be aware of it, over here is a 500. So the total outlay of the capital is not 1,500. It's only 1,000, right? So it's 1,000. So this was a 5-point wide, and this is now 15-point wide. This is now 15-point wide. Now, again, this trade, in a light of what we just did over here, it almost seems contradictory. And that's why I'm building this, because I want to bring it together and explain how this whole thing works when we have a combined situation. So I have a bear call spread, and I'm going to again create a sheet at the entry and at the exit. So let's now lay this down with the same pieces of information. Entry is at S&P 4100. And what we have here is a simple that we sold to open 4150. We sold to open 4150. And then we need to protect ourselves with something higher, and we bought to open 41.65, which is way out of the money. These things are way, 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 way out of the money. So because we did that, we were able to receive the credit of the 65 cents. So we got the credit of 61 cents. So now let's say we have a situation that S&P is again closing at 41.50. So it's at expiry 2041, not 41 and a 1 penny, but exactly 41.50. Exactly 41.50. What would happen with this entire spread? Well, obviously, this would still be out of the money, and we would keep the maximum profit. We would keep them a maximum profit of 65 cents. Which means, in that case, that also this trade was a complete loss, because our debit over here is a 45 cents. Well, yeah, but we still made the $20, and we were dead wrong. So Jeff, Joe, please let me know, how do you like this strategy that even when you are wrong, you still made some money? But if you're right, as I said to you, depending where this thing goes, we can definitely, in that case, have some profitability if this thing goes into the supply zone and stops in it. I like your feedback. That's good. So let's now build this thing for bull call spread, bear put spread one more time from the beginning. So I'm going to just use this as an edit spread because it's easier than anything else that I was doing earlier. And I'm going to be changing this again to the July 29. July 29th, I'm selling to open the higher unit, which is a 41.65, which is way out of the money. And that's actually the one that is being bought. 41.65 is being bought, and sold is 41.50. 41.50 is the one that is being sold, and exact prices is that I received 90 cents for the credit, but then out of that credit, I had to give back 25 cents. So I had to give back 25 cents. So now when I show the outlay of this one, it's gonna look quite unfriendly in terms of the how much are we risking versus how much can we make. So look at it. This is a risk and this is a profit, right? So I'm risking over here, and just make sure that you kind of follow this logic, that on this trade, which is a bear call spread, my risk is not something that is going to attract a lot of traders, because I'm risking 1,435 in order to make 65. But when I combine this as a call, broken wing butterfly, that's not the case. That's not the case. So watch what I'm going to do right now. I'm going to add one more leg to it. So I'm now editing the spread, adding one more option leg. So this is the one that we bought originally, and it's a 41.45. So 41.45, we bought that particular unit for $1.35, and then we sold two of these. So now risk to reward graph is going to be quite different. So when I click OK and I go over here where it shows risk and reward graph, information is right there ready to go. So I have done this in two pieces, but this next one that I'm going to put in, it's going to be done in one piece. So how do we get the 65 cents? To keep the things as simple possible, right? In a summary, okay? You take the 65 cents credit, you subtract from it 45 cents debit, and then you get that 20. So Joe, you like it? Jeff, you like it? Yeah, okay, so let me show you now, in terms of the execution, how I could have done this all on the one thicket, as we like to say. But right now, you don't need to worry about thicket. You select the gut where you're trading. That's where you select. You single right click, and you go where it says buy. Now be aware of it, you're buying a butterfly, but you are breaking the wings by simply adjusting it. So when I look at right here, is my 41.45 okay? Perfect. Is my two sale of the 41.50 correct? Yes. What is the difference? Well, the difference is that when I looked at the chart over here, I saw that this resistance is ending at the 41.64.86, but obviously we don't have that strike price, so I have selected the 41.65. So as crazy as this sounds, I want this to come to me into that area of the supply zone so I can achieve something better than. And look at this. Right now, if I were about to place this, I would get only 5 cents credit. So what is really happening with the market? The market is no longer conducive to that particular trade because, ladies and gentlemen, it's going down. So if it's going down, could it be that all these premiums are changing? Sure. So I can fire this trade one more time. Give me the credit of the 20 cents. I would be shocked. I know I'm in a paper trading account. If this trade gets filled, I would be really shocked. No, it's going to be working there and it's not going to get filled. So I have a working order over here. Try to get filled for a 20 cents credit, something that is what? At zero. At zero. So just be aware of it. This was a part of the lesson that I wanted to do this morning to present to you because, in my opinion, it's extremely powerful, especially on a day off. So all the good and bad of it is that I personally like to call this call butterfly. This is a call butterfly that has a 5-point wide bull call with the bear call. I like to call it. This is my translation. And I'm going to just put it here and I'm going to have you guys read it. There it is. That's my definition. That's not the textbook definition. That's not the Google definition. That's not whatever you want to call it. It's just Josip's definition of what is a call broken wing butterfly. So first B is broken, W is wing, and B is a butterfly. So BWB, broken wing butterfly. Call, broken wing butterfly. Call, broken wing butterfly. It's a bear call spread with the built-in protection. And why do I say it's a built-in protection? Because now if you look at the market, oh, it was going down, but now it tries to go up. Sure, let it go up. Come to me. I don't care if you come to me because I really don't have a bear call until it reaches the what? 4150. And when it reaches the 4150, I'm smiling all the way to the bank because, ladies and gentlemen, for my lousy investment of the 45 cents or the $45, I'm getting here $500. So yeah, you went against me, but I actually profited from it. Only problem that I have when this thing actually goes beyond me. And what do I mean by that? Well, let's go back over here and see if I'm going to get filled. No, I'm not getting filled. So what I'm going to do here, I'm going to take a duplicate order. I'm going to just point out to you here, where's my break-even point? My break-even point right here, if you can look at it, is right here. 41.55 and 20 cents. 41.55 and 20 cents. So that's mean I really don't mind even if this pierces to 41.50 as long as it doesn't go by additional what? 20 cents. Because look at it here. Same break-even point whether you got that on a platform or you got this from us here at the top, Trade Active Option Planner. Break-even point doesn't matter up or down, is at up or down 41, 55, 20. How do you get that? It broke to 41.50. It went by $5 on my long unit, but because I got this right here for and then let me just finish this for $20 of the credit. My commanding unit is actually this one. So what do you teach us today? I taught you today SPX call broken with butterfly, which really in the simplest possible explanation is a bear call with the built-in protection. And that built-in protection is this 5 points wide out of the money call that it's a debit of the 45 cents that is financed by this 15 point wide, still out of the money call for 65 cents. That in the worst possible scenario, can make you $20. Can you make $20? Okay. Let's talk about the risk. How much am I risking? I'm really confused about that. How can that be? Well, okay, let's do the math, okay? It's a $15 wide spread, right? So when you add 520 plus 980, you're getting 1,500. But I still don't follow this. I don't get this. Okay, your bear call is a 15. Your bull call is what? 5. So when you subtract that, what do you have on the risk? You have a $1,000 risk, right? $10 risk. So be aware of it from that $10, right? Which is $1,000, right? The 10 points, because you need to multiply this by what? 100. We already know that. So that's then 1,000. Why this 4 got it? It must be the fat finger. Okay. I got the credit of $20. So the most that I'm risking is what? 980. But had I done this separately, what would they do first? They would first take on the bear call spread 1500, and then when I do the other one, which is a bull call, that is a $5 line, and then they would turn the five. But net, the math, maximum risk is only what? 980. That's why we get this 980 as a maximum risk. So I know mathematically this thing, when I do it in the pieces, it appears scary. But this thing could be done to the downside as well. But that's another lesson, and that's another lecture altogether. I do not want to teach division and multiplication at the same time. Because if you ever had that over enthusiastic teacher who taught division and multiplication at the same time, you walk out of that classroom convinced that you don't know. When in reality, it was a teacher who didn't know what the heck he was talking about. Because there's no way that normal teacher should try to teach division and multiplication the same day at the same city. No way. No way. Go over this lesson, first half an hour, as many times as you can. Give a like if you understand, but I want to now evaluate some of my existing positions that we have placed before, right? So I said the agenda is first teach the broken wing butterfly, and then the second part of is review the open positions in a paper trading account. So if this was heavy at the beginning, now it's gonna get way lighter. And the reason why I say it's gonna get way lighter, because over here, well, we have a session tomorrow. Oh, look, they gave me 20. So it did, but you see, I don't trust this because it's now paper trading account. So now I have two of them open. Anyway, what I was about to go over with you are these existing positions that I have. So if I go piece by piece through these existing positions, I think the most appropriate place to start is the one with the information that I already have posted in the last live session. So using the top option trading platform, we looked at the volume and we concluded that XLK was a good bullish trade, and that was on July 29th. So let's now make the things simple. Go back to the good old chart of the XLK and locate the July 29. Okay, so July 28, 29. So we are right here in this consolidation mode. So we had a rally, we had a little bit of pause, and since then we rallied, but today we are already pulling back. So perhaps whatever I have done back then when the XLK was sitting at the 141, I should reconsider because maybe I need to take those positions off. So one more time. So we traded the XLK at the time, and we actually did the out of the money 130 put. So check this out. If we are at the 141 and I'm picking the 130 put, and we sold that for a nice premium of the $279. So that's mean we risk 130 put times 100. That would be $13,000 minus $279 of the credit, right? But what do we see at the chart when we did that? We saw, well, look how conservative you are. This was here demand zone. We actually went even lower demand zone all the way. Wow, we went number of these things lower. Yeah, so we actually picked lower uh, demands. Not the, we actually even assumed this can come down and fill the gap, and then we picked the 130 right here. This is where we actually said to the market maker, feel free to fill me in right here at the 130, and we were sitting at the 141. So obviously today we're not at 141. We're coming down actually right now pretty fast. But let's see now in detail XLK position, right? So this one that was sold. Okay, let me do this. I'm going to click the symbol, so it's going to be easier to understand. When you click the symbol, it groups these symbols correctly. So notice we did have a bear call spread, right? A bull call spread, but we did also have a that sold put. So the one that we sold for 279, I can now cover it for what? 47 cents. 47 cents. So let this thing sink in a little bit, because if I exit this, it's true that I did not make entire amount of the $279. So $279, if I exit this right now for the $47, is gonna free my capital of close to 1,300, right? But be aware of it that I ended up making $232. Well, I lost you. I'm kind of not following what you're talking about. Okay, XLK, right here, buying power effect. That's what I want to free. So I want to free that by simply exiting this trade. So I'm going to be now single right clicking, close order. It says a 49, but I'm going to try to get out at 47. I don't know if they're going to give me a 47, but I have time. I'll wait. I'll sip the water. And by the time I'm done sipping the water, I want to point out to you that what I sold for the 279, I exited for 47. Here it is. It's black and white. It was written on a July 19th that we sold this particular thing at the time. At the time, we sold for oops, maybe I zoom in too much, for 279, right? So we risked this much, and now we free all that money because we gave them back lousy 47 cents. But then that's a part of the trade. There was another part of the trade, and that was doing the bull call spread. So we did the bull call spread, and the total value of that bull call spread was the debit of the 271. Well, I don't get that. Well, why don't you get it? We received 279. We ponied up 271. Net, we were still up $8. Could I close that particular bull call spread for some money? Well, let's just think about it. We had the information that we did the 132 and 137. Did we pierce to the 137? Well, let's look at the chart. Let's look at the chart. Let's Men lie, the charts don't. We're now at 142. So what do you think it happened to that particular sold 137 that back then was out of the money call? Is that in the money? Yes. But then what happened to the lower call, that 132 call? Well, now that's also in the money. And if I know that the market is now taking a breather or pulling back, should I then risk? Okay, now you had the green bar up, but notice that this particular green bar did not take out the entire 10-minute red bar. So at this point, on both Nasdaq and S&P, the bears are winning, but that's not true for the Dow, because as you can see on the Dow, did we take out the high of that red bar? We did. But on Nasdaq, we did not take out the high. So that means the bears are winning. Same on S&P. So who do you think is going to be winner? Do you think 500 stocks are going to be winner? I'm sorry, I was trying to get this rid of. 500 stocks are going to be winner? 100 stocks are going to be winner, or the 30 Dow? Well, I would think majority, because this thing, in comparison what it was over the last 2 days, was a sea of green. Does this give you impression that this is a sea of green? If it wasn't for the energy, you would not have even one sector that is beating on all cylinders to the upside. This is such a mixed bag. It's end of the month. Market has rallied on news that you would think it's supposed to go down. So, having said that, I hope there's agreement that absolutely makes no sense for me to risk this 555 that is now double virtually at 1170. Now be aware of it, my 137 has gone against me because I sold this for 284 and now it's at the 7. Well, it doesn't matter, ladies and gentlemen, because as long as I exit this for a more than what I paid for, and I paid for it 271, I'm exiting at 427. So Jeff, Joe, should I take this or should I be greedy? Feel free to type it in because it takes 1 second for me to click this. Take money and run. I got it. Why not? I'm sending it now at 427, but be aware of it. They're going to say, no, we're not going to give you 427 because look, the bid and ask spread, is 410. So drop it down to whatever. And then we're going to feel it. Look, now they want to what? 405. That's not how you take it. You take this in a strides, which means you wait a couple of minutes and okay, you know what? It's okay if I give them 2 cents because now I'm somewhere in the middle of this. So I didn't get the maximum at 427, but I'm willing to take it to 425. Oh, I don't even see what you're doing. Well, this is what I'm doing, ladies and gentlemen. If I change this open interest, actually, I shouldn't even change open interest. I should add one more column here. Position. That's what I want. You will see my position. And this is so deep in the money. I would need to have maybe 45. So you would actually see how deep in the money that is. This is how deep in the money that is. So of course you can do nothing, but be aware of it. This is a $5 spread from 32 to 37. That's already $5. What about if you have some crazy thing happen between now and 21 more days? And you were up virtually 90% on your trade because really, I mean, what's the most that I can make on this $5 spread? $5. And because of my greed, I don't want to take it out. Okay, I'm going to drop this to 20. Let's just see if they're going to take me. Because I have other things I want to evaluate. We're going to have another 15 minutes. There it is. 425. They even gave me improvement. So they gave me improvement. So what I'm trying to get at is that the trade that we placed together was an XLK. So on XLK, we sold, let's see exactly, I still have information here. We sold 130 put for $2.79 and covered it today for 40 cents debit, earning. I don't like the word making money. We earn. This is going to work. Waking up in the morning and looking at the market and clicking the mouse, it's work. It is work. And also we had a bull call that involved 132 and then a sold 137 that was debit of the 271. I remember this is how we did it. We took this money to pay for that. So this green thing was a credit that we received to pay for this um, debit. So there it is. So that was the original trade right there. And if you want, I can later on update the sheet and you will know. And we exited that for 425. I'm sorry, I have a fat fingers. I gained some weight, so let me now again have this visually here so you would see it. So we had 425, but I didn't make 425 because what I had to pay for it, 271. So we earned on this one. I just took it away. 154. So on the both trades, so that's 154 plus 232 is 308. $386 while keeping invested. It was something like this, minus whatever we paid for Alex, 279, whatever it was, that's something like this. Okay, so when you look at that, so I got the $386 on my investment of the three. Yeah, that's correct. So times 100, because I want to find the percentage. So I got the 2.9%. So I got the 2.9% from July, I believe the thing said the 19th. Let me just see, July 19th. Session was, yeah, July 19th to July 29, 10 days. From July 19th to 29th, meaning 10 days. Joe, Jeff, is this good rate of return on your investment in terms of outlay of the capital? And guess what? Broken with butterfly is just as good, baby. Only thing is, it's in one day. So whatever we did here in 10 days, over here is done in one day. Anyway, let's just look at the chart one more time to see how's our SPX doing before we dismiss. SPX is still doing nothing. So guess what? We might not hit that level at all. But for your frustration, you already got paid $20. You already got paid $20. How did you get paid $20? Well, you got paid $20 because you have structured it in such a way that you finance this 41 cents of this out of the money 5-point wide bull call spread with $15 wide, $15 wide bear call spread. And bearish is coloring red, bullish is covering green. Visually, I know there's a lot of numbers here, but ladies and gentlemen, all that I want to say to you, this is the only thing that matters here. This, that's it. Forget all this. It's irrelevant. Of course, strike prices are relevant. Don't get me wrong, but these are when too many numbers. What's the bottom line? 65 cents credit for it. So if I'm dead wrong, $20. There it is. You can go to Starbucks and you can treat somebody with a drink. And you were wrong. You did not exceed. You did not achieve what you wanted to achieve, because really, I mean, what you wanted to achieve is a market going up. But now, this very second, 7 minutes before he also finishes the lesson, this thing is going up. Yeah, but does this still look to you very convincing? The Dow might actually take out the high. That's very interesting. The Dow has only 30 stocks. They might take out the high. But NASDAQ, just now they're attempting to take out the high of this 10-minute bar. Just now. So it took them 30 minutes. Check this out. Each of these bars is 10 minutes. How do you know it's 10 minutes? Well, look at right here. The session starts at 9:30, ends at 10, right? So this vertical line right here, how many bars do we have? 3. So this means 10 minutes. So it took 30 minutes to negate one of these red bars. So be aware of it. Over here on our platform, we have a position that is involving 3 different units. 2 are being sold, 2 are being bought. So these that are being bought are each one piece. They're each one piece. So because they're one piece, you have a one long 41.65 and you have also one long 41.45. The 2 of the same that you sold, it's a 41.50, 41.50. 41.50, 41.50. So just be aware of it. That's the way how this trade is structured. So let's review the other existing position that we have in a paper trading account. Because if we review the other trades that we have, we're going to conclude that um, so this XLK has well, it shows today P&L loss because this price did go even higher, but I did not exit it at the all-time high. And because I didn't exit it at the all-time high, I didn't necessarily made all the profits over here. XLK 386, and I think that's pretty much what we calculated when we looked at this thing. So again, let's just see the other trades that we have currently open that we can exit in these last several minutes. So options. Okay, we also sold cash secure put on XEL. So that's one of the trades that we did when we were going through the sectors, and we like to have that particular trade put to us at 60, and we were willing to risk $6,000 minus the 115, and right now it's worth only 62 cents. So I can close this right now and make a half of the profit, but I should first look at the chart. Now be aware if this is way longer trade. This is a December trade. This is not the one that we just exited, which is August around the corner. By the way, in August, I'm going to be traveling in Europe, so I won't do any sessions. I'll do again sessions in September when I get back and I get rested. So one more time, the ticker is XEL. XEL. So XEL. XEL. So we said we want to have the stock put to us all the way down here. Look how much data I need to bring. I probably need to go even more to see where this is 60, all the way below. You see where we got that 60? It was number of these green UFOs unfilled orders that we said we want a 60. Yeah, so somewhere in this area we picked a 60. Yeah, and the price is now at 73. So that's like 13 points away. We took out this high. We can go higher, but the one thing that I'm a little bit concerned. This is my little bit concern. If I draw from here to here, you see how we're kind of coming into it. Um, this huge move down can bring us down to 70. I don't know if it's completely up to you, whether or not you want to take this trade. Now be aware of it. This trade is tying up $6,000. So this is sitting at the 195. If I now close this, so this thing's supposed to jump by $6,000 once when it gets filled. Bingo. So it jumped. Okay, Verizon look terrible. Verizon trade. I need to show you what really happened on the Verizon trade, so you understand. And I would need to be on the weekly for you to see how bad the Verizon trade turned out to be. Fat finger. Verizon trade on a weekly. They missed the earnings. Why? People are not paying their cell phone bills. And when you look at this kind of move, this is horrendous. Let's look at the monthly over here. They have had really bad month because many people don't pay their cell phones, and our trade that originally was placed. Look, this isn't even as bad as when we had the COVID crash. This kind of bar, the size of the bar, is similar during the COVID crash. So our trade here was a long trade. We bought a 50 call and we sold a 60 call because we were anticipating at the time we're gonna go higher. Complete loss. Complete loss. Do I need to close it? Close it for what? Pay more commission? I'm gonna just let it expire worthless because be aware of it. My $50 call, wow, the Verizon is, I don't know why I keep typing VX when it's VZ. It's 46. It's $4 below. So look, This would have been a perfect bear call. Had I done the bear call, it would have worked out. But no, that was a bull call because at the time everything looked bullish. We went through the sectors, losing trade. Okay, how about this one? VST. Let's look at the VST and then call the session off. VST. VST. Oops, again, I missed that. VST. Whoa, this is looking good. It's looking good. When we traded it, it was. Let's just not look at the monthly. Let's look at the daily so you would see. This is really looking good. Yeah, it's really looking good. Maybe we don't need to do anything about this trade because it's October trade. So we sold it. We said to the market maker, we're willing to risk $2,200, but you need to pay us $110. And obviously now this thing is not anymore at 22, it's at 25. It was consolidating here for a long period of time. This particular formation is called cup and handle, and then we broke about the cup and handle, we're going higher. So that's mean we have a winner on sold put, and we use that money, the $1.10, we use to finance this. Now be aware if this is a $2 spread. This is a $2 spread. So if I want to close this spread that I originally paid, what is that, 50 cents? So because I paid 50 cents and I got here $1.10, I was able to do two of them. So if I'm now closing this, it's still 55 cents now. We have it till October. So when I come back from vacation, then we can review these trades. So Jeff, Joe, it was nice seeing you. I wish you all the best. Stay safe and hedge. And bye. See you in September.